Hi, welcome to another episode of 10 Minute Strategy. I'm here with my friend Marty Isaac, who leads the Angel Investor Forum here in Connecticut. And we're here to talk about angel investing. So, Marty, thanks for joining us today.
No, my pleasure. Always enjoy talking about angel investing.
Yeah, well, you've done really well with it. So, leading off from that, what do you look for in an angel investment, and what percent of your total investment portfolio is in angel investing?
Well, that's a great question. So, I think a lot of people like to say, it's a very speculative world out there. So, taking 5%, 10% of your net worth and putting that into something speculative seems safe or something safe to do. I wouldn't do much more than that. However, I have been fortunate and many of my angel investments have done well. So, it ended up being significantly more as a percentage basis of my net worth are in these companies. But from a raw investment perspective, I started with that guideline of roughly, 5 to 10% that I was going to put into play out there. So for me, when I'm looking at angel investments, I kind of break it down that it gets pretty easy. It needs to be something that's solving an important problem in a market that's large enough that if everything went well, it could get large. But the most important thing of everything I'm doing, it's all about the team. The team has to be superb. And that really is kind of the most important thing that I'm looking at is team, team, team. If it's a great team solving an important problem in a big marketplace, I get pretty interested.
Right. And so maybe you could talk about some of your favorites that you've had some success with, because it's nice to hear
Right.
stories.
Yeah, I've been fortunate enough to get into some really terrific companies. I was the last pre-seed investor into a company called Loom. When Loom is an asynchronous video communication effort. So what you and I are doing right now is synchronous. Zoom is synchronous. It turns out that asynchronous can be extremely valuable. When you think about email, when you think about text messaging, they're all asynchronous ways of communicating. And for me, I happened to be, when I first found Loom, I was developing a website that was being programmed over in India. And it was challenging to communicate when things I wanted to change. How would I do that easily? And I would take a screen grab and I'd write a Word document. It'd take me 15, 20 minutes to do it, as opposed to just grabbing a very quick video and communicating what I wanted to communicate in around 30 seconds and sending it off. And it was easier for them to understand. And so when I saw the technology that we're using, just how easy it was to do it, they were clearly brilliant guys. I had no idea how young they were when I first invested. They were younger than I imagined. I'm glad I didn't know. But they're brilliant guys, and they've executed flawlessly. They've pivoted along the way, figuring out how to get distribution. But they've done remarkably well for themselves, and very excited for them. And it's a wonderful investment.
Right.
That's probably my lead one out there. The other large one I had was a meditation app called Calm. And I was fortunate enough to get early through a syndication. I did not have direct access to that deal. I got that through a syndication effort. And thankfully I did. That was an incredible investment. When I got in when it was worth roughly 4 million pre-money. It shot up all the way up to, north of 2 billion, I'd say. And, who knows where it is right now, given all the challenges out in the marketplace now. But it's, let's say it's somewhere between 600 million and 2 billion in valuation, but pretty good from 4 million pre.
Right. That's amazing.
Yeah.
So what is the typical exit for a good angel investment, and what percent are good? And then how long, most importantly, how long is it, I think it's most important for me, is I
Yeah.
think, how long does it take for a typical angel investment to deliver returns from some sort of exit?
That was probably the surprise for me. I think when I started this 10 years ago, I was thinking in my head, I knew it would be illiquid for a period of time, but I was thinking it would be illiquid for 3 to 5 years.
Right.
And that was definitely too early. And, maybe it was that case a long time ago. I don't know. I think, my expectation today when I'm investing is it'll be illiquid for 7 to 10 years. I think
Right.
that's probably much more realistic. And, how do you ultimately exit a company? By and large, it's because another company buys them. I mean, there's always the rare exception where a company could IPO. And I mean, even when the market opens back up and IPOs start being a thing again, it still is incredibly rare that a company is going to exit from an IPO. It's much more common that either private equity, a strategic, or some company is going to buy this company because they're successful. And over that period of time, that's what I, anticipate will happen. I think you had another question in there, so I did the time frame and how I think they'll exit. Oh, percentage,
What
percent.
percent are good? Yeah, what percent do you think are good?
It's really tricky. I think the data overall is, roughly 50% are going to go to zero or come back with less than, the amount you invested in. Some people put that rate as high as 70%. And so if you just do the basic math and you say, well, how am I supposed to win at this game? If you don't have winners that are increasing, 20 times, 50 times, 100 times in value, the math says it's literally kind of impossible to win. If half your investments are going to go to zero or 70% are going to go to zero, you need your few winners to kind of cover all the losses. For me, so far, I'm in around 140 companies. And so far, I'd say 18% have gone to, out of business or an acqui-hire or something like that. But I have a whole lot in process, I would say, that probably will drop out. I think I'm going to beat that 50% rate. If I think I'm going to beat 30%, 30 to 40, which is a fantastic number. And I'm hopeful where I stand today, for every dollar I put in, I get approximately $4 back out. In 2021, I would have said I'm going to get $6 to $8 back out, but the world has radically changed. So I think it's probably more realistic. I'm going to get $4 back out for every dollar put in, but that's over an extended period of time.
Right, right. Well, I'm in many fewer angel investments than you by a, yeah, whatever, a big factor. But I it is interesting to watch them. It's interesting to see what they do, especially those that are communicating what's going on, and which leads me to my final question, which is,
Hmm.
what are your relationships with the companies where you invest? I know you like to know that there's a good team, but do you expect quarterly reviews? Do you receive reviews updates regularly? How's that work?
That's a good question. It's changed over time too. When I first got involved, I thought, part of the game here would be, I have some expertise in direct marketing. And I thought companies, particularly that were involved in something related to that, and all internet, it's kind of direct marketing, that they'd want my assistance, and maybe I should be a market advisor and get some equity shares for that. And I did that once or twice. But as I did this, I realized that is not the way I want to be involved, nor necessarily it's best for the founder. I really am a connector, and I really want to be there to support the founder in any way that makes sense for the founder. I think the worst thing that can happen is when an angel becomes a pest. And, the founder has enough things they need to worry about to be successful. And the last thing they need is an angel second guessing and doing. If I can be supportive, I want to be supportive. And when they reach out, I always want to be there and help them. And when I see, an obvious connection for them, I'll ask, would they like this? Can I help you with this? When I see an article that I think is important for them to be aware of, I send it to them. But I really try to be responsive to them in terms of how do they want me to help. And typically, in their communications, I wouldn't say it's quarterly. And sometimes people make fun that, if you get too big of a communication, it often is inversely correlated with the success of the company.
Yes, right.
So I listen, I like to get if I can get communications every 6 months, I'd appreciate that. Some do, some don't, but I like a brief communication. I'm not looking for a giant essay. I need, 2 paragraphs, 3 paragraphs, a couple bullet points, how much cash is left, a couple key statistics, and help me understand what's happening so I know if I'm able to help them. But I'm not looking for a book. And some people do that, and I just think it's a waste of time. I'd rather have them focused on other things that could be more important.
Right, operating their business. Well, I think you and I are together on one investment here in Connecticut, and we do get a nice summary from the gentleman, and it's nice to see. So we've got a minute left. Um, the 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 other the group that I've invested with out of California, I get nothing back. I don't even see. I think they get reports, but they don't share them, and I find that irritating.
Well, it's irritating, and I think it's a mistake because, particularly as you walk into this environment and you may get a surprise communication of, "Hey, we're in trouble, and what are you going to do to help me?" If you didn't build your relationship along the way, I just think it's more challenging for that founder to, maybe get out of a jam.
Right.
And if you kind of see things coming, I can't tell you how many conversations I have with founders of, you don't have enough money and you really need to be, I've been doing this for the last year on talking to founders, like you do not have enough money and either go round out the round or cut back on burn. You need to watch yourself. So I think it's important for them to establish relationships with people that can help them. And a lot of angels are prepared to do that.
Great. And then, one thing we just didn't get to is, the criteria to be an angel investor is it's sort of a funny thing. It's a little bit loose, but can you just talk about that while we got 30 seconds to go here?
Yeah. So, the old rule was you had to be an accredited investor. The governments wanted you to be sophisticated because you're investing in something that is high risk. And accredited means you were making over 200,000 a year, or you had over $1 million in assets, excluding your house, and or a couple other options. In 2016, the rule was modified for certain crowdfunding engines that almost anybody could begin to invest in certain mechanisms to enable that. I think there's more work to be done there. I think it should be open up. There's no reason why the average Joe can buy crypto but can't invest in an angel or in a small company. It doesn't make any sense to me. So hopefully they'll do some more work there.
Excellent. Well, this is great. If you're in Connecticut and you want to go to one of Marty's events, it's the Angel Investor Forum. You can find them online, and always new ideas to think about. And I think that's, if I could wrap it up, that's one of the reasons to get involved in angel investing is because you get exposed to new ideas, things that are going to be happening that aren't quite happening yet, and that's stimulating. It's interesting to think about. Certainly interesting to talk about with your friends, and sometimes if you get lucky enough to get into Com or some of these others, can be really rewarding financially.
It can. Peter, thanks a lot. I appreciate it.
Thanks for your time, Marty. Great to talk to you.
You too.